Welcome to Top M&A Entrepreneurs today. And having a guest back is Bruce Marks. Bruce was one of my first guests many years ago. Well, it's 2 years ago. That's internet time. So, Bruce, welcome back to the podcast.
Well, thank you, John. Pleasure to be here, and I'm thrilled that you've invited me back.
The reason I reached out to you is I'm not killing it on X, but I've been following your conversations, and you're blowing up there, and you had a great conversation on debt to debt and more debt. You got to make so sure, when you go into a 10-year term personal guarantee, that the business can handle the debt.
That's right. Yep. 100%.
And you got your own personal experience too, because you just told me you're also an SMB owner too.
Yeah, twice over. So yeah.
Since we talked, you bought 2 businesses.
Yes. Yep. Absolutely.
Awesome. I guess you know where you got your loan.
You actually know I can't get a loan from First Bank of the Lake.
Oh, you can't. You're too close. So let's start this because somebody posted right after you, a guy named Mike the Lummox. He's an SMB owner. I don't know what kind of business he has, but he goes, listen to Bruce. SBA 7A loans are a one-way door. There is no escape hatch. That's good enough to scare you off, right?
Yeah.
Haven't experienced what this looks like in practice. I can tell everyone now, just because you can pay your SBA doesn't mean your business isn't starved for cash flow. Lower cash flow means a lot of bad things. Less money available for strategic investments, less money available for catastrophes. And you just shared something with me about that.
Right.
Less money in your pocket and less hair due to stress. Yeah, I got that problem. So
yeah,
you know what to do to internalize this. So this is a starting off point, but you had a great post and a thread that kind of addressed that. So let's start talking about that.
Yeah. It was really a meaningful, conversation, John, and it wasn't so much, about SBA financing or the debt financing piece, because literally, as I mentioned in the thread, spoke with the searcher for about an hour, and literally 5 of the 60 minutes were talking about SBA, right? It was, he had a terrific model, to be truthful with you, one of the best that I'd seen.
You mean he penciled the model out on a spreadsheet?
He penciled the model out. It was really, really good. Like I said, one of the best I've seen, because it allowed us to really drill down and say, okay, a lot of people are kicking the can down the road. Oh, the SBA, the seller is participating. He's going to sign a 2 standby, and then it's going to be, 8-year amortization. So it matches the length of the SBA loan. So I can kick the payments down the road 2 years. What he wanted to do, and what we had a conversation and talked about was, well, in 2 years from now, when you have to make that payment to the seller, what does it look like? And so we went through that model, and it was just like over 1. And then I said to him, most people, the presumption is that you're going to grow the business, right? You're going to buy it. That's, as I always say.
Everybody, I got to, even this little private equity group I'm involved with, they all think that we're just going to grow this 10X.
Well, because the thought process is upside is theoretical.
Yes. It's not there. It's
and
a multi-year effort.
Upside.
Yeah.
Yeah. And searches are theoretical because that's what they're buying. But as a business owner, and you as a business owner, because I know your investments and the things that you do, that's not always the case. There's no guarantee, to Mike's point, that you are. So what we started to do was we said, okay, let's look at how much cash flow we do have after year 1. Let's look at how much cash flow we have after year 2. And do we have enough to start to make those sellers to the, those payments to the seller?
Yeah. But let me ask you a question before you go into explaining. Tell me a little bit, animized of this guy. Was he a private equity guy? Was he what was kind of?
For sure. Yeah. I mean, very strong background, very knowledgeable. Not my first conversation with him, for sure. Not even my second conversation, because a lot of times people will ask me, Bruce, when do you want to get in? And I say, way pre-LOI, right? Like you have to, like in this particular case, because even somebody had made another comment and said, hey, wait a minute, I feel bad for the seller. This deal was an LOI. And I went, no. Go back and read the post. It was pre-LOI. So I like to get in with my potential clients really early to talk about this kind of subjects, right? Because to my point, you don't have the money, you're guaranteeing an SBA loan, John. You can't be wrong. And that's what I tell my searchers. I'm the first one to walk from a deal.
Yeah.
You cannot be wrong.
You have one job and you can't be wrong. It's like the Secret Service, you have one job. With SBA, you can't be wrong. Yeah.
And we know when something does go wrong, the potential, right? You saw that over the weekend, right? So in any event, what we looked at and what we talked about was the business this searcher was looking to acquire required a lot of inventory. That was the way growth was going to happen.
Yeah. Is it e-commerce or manufacturing or something?
No, it wasn't in the e-commerce business.
No.
So I said to him, when you add that dynamic, and then if you bring on investors want a pref. And if you're buying a business that's going to make $1 million in EBITDA, it's not unrealistic to think you're going to have some type of taxes at the end. Uncle Sam's going to be standing there with their hand out going, there's some. So when we modeled it, it really fell below. And the point of the whole thread and the whole conversation is there wasn't enough money to allow him to actually grow the business because there just wasn't enough money left over for any and all the other stuff. When you look at it and you say, this business has got to pay me, the searcher. It's got to pay SBA. It's got to pay the seller. It's got to pay the employees. It's got to pay the landlord.
Quarterly taxes, which you just mentioned.
On and on, right? Yeah. You've got a ton of people pulling on those purse strings. And it's funny because when I get into conversations and I'll say to searchers, let me see your projections, it's always 5% growth, 5% growth, 5% growth, 5% growth, 5%. That's not realistic, right? Because business has its cycles and it goes up and down.
Yeah, there's not a P&L I've seen over the last 3 years where COVID goes, come on.
We, in the businesses that I've bought over the last, year and a half now, it's kind of like the J curve. And I tell people that because I live it. This doesn't really happen. It's just not realistic. It's more, especially if you're buying a business in an industry that you're not familiar with, that you don't have a lot of connections in, and sellers are going to tell you what they want to tell you for you to enter into that LOI, right? I'm not saying that they're not 100% truthful, but I'm not saying they are 100% truthful, right? So the learning curve, once you get in there, and then, well, what if you need money to make some capital improvements? Or what if you need money to redesign the website? Or what if you need money to grow the inventory? Or what if you need money to hire new employees because these ones aren't the right guy and you got to use a recruiter and you got to pay them 30% of their salary? I mean, this is all real business that you need to understand. And to my point, it's not about just servicing an SBA loan.
Yeah. Yeah, I'll bring in a point. I had a buddy that owns a manufacturing business, does truck parts down here in Tucson, and his brand new CNC machine was down all the time. Not only did he have to put money into it, but he had to find another way to those machines with other CNC machines that was going out. So there's depreciation with that manufacturing.
Manufacturing, CapEx, constantly, like to your point, buying the equipment, the working capital. People will call me and say, I've got a business making $1 million in EBITDA. One is in manufacturing, one is in distribution. Are they worth a different price? Yes, they are. Because what it takes to make $1 million in manufacturing is not what it takes to make $1 million in distribution.
Yeah.
Right?
Yeah.
So the business and the distribution has got a higher multiple because in a manufacturing business, and I've seen a lot of manufacturing businesses during my time, John, believe me, it is hard. It is hard to make a lot of money. And remember, these business owners are selling a business that maybe they've had 25, 30 years, and they haven't had debt, right? And now you're coming in and you want to stack $4 or $5 million in debt on this business.
Yeah. Let me point out a specific example. you go look at a manufacturing business out in Ohio that the guy's owned for 30 years, or maybe it's a 50-year family kind of deal, and they bought the real estate 30, many years ago.
Yeah,
They
yeah,
have
yeah.
no payments on that. Zero
Yeah.
payments because they bought it outside of town.
Yeah, yeah, exactly. And then they go, okay, well, and so the guy hasn't been paying rent, right? So now you're going to come in and you got to make a payment of rent, 30,000 a month, and you go, wait a minute, how does that affect the multiple I'm going to pay?
Yeah.
And that's the point. I mean, where I come from in the way that I look at my role today, being impactful is everything for me. And I think the best way to do that is to share all my experiences as an entrepreneur, as a senior lender in a bank, as a business owner, as a commercial lender, all of that, and say what makes sense. Because I'll tell you, when all parties get up from the table and say this was a good deal, that's when it's a good deal.
Yeah.
But I've seen so many where I had a conversation with a guy I'd like to share this morning, and I just said to him, look, you're offering, this seller has an expectation of price up here. You want to come in and you want to offer him $1 million less. Now you want him to hold a note, for 500. Then you expect him to leave working capital for 500. So he's 2 million below already. He was expecting here. You already offering $1 million less. You want him to hold the note for 500,000. So now he's down $1.5 million, and you're asking him to leave $500,000 in working capital. But then he's got to pay his broker. He's got to pay his attorney, and maybe some capital gains tax. He's going to have an epiphany in the middle of the night, wake up and go, hell no.
It's just like, don't sell. Don't sell.
Yeah, no. What are you doing? I thought you were walking away with 5 million. Oh, no. But that's the realities of it. And, when you're buying a business for the first time, which a lot of these searchers are, and the sellers are selling a business for the first time, which a lot of them have to.
And it's a one-time event. It's usually a one-time event.
It's as I always tell my searchers, when you buy a business, you're going to exit, whether you want to or you're not. Right? You're going to exit, right? So, but generally, and you want to exit under your own terms and conditions, right? That's the whole, right? But what it takes to get a deal to the closing table is just so much more than just to your point.
Yeah. So I have to ask you, because it comes up. Having said that, all this and the fear of it, and just making really sure before you walk up to the, where you're getting married to this woman and you go, I'm going to have sex with this woman for the rest of my life, right?
Right.
But one, you got to really, really make sure. Is there an alternative to buy a business without SBA? Really not, is there? Unless you do, and not saying like you're not a general manager for the business and you can come in and go, hey, I want to use 100% seller finance. Well, you've already been with the business for 15 years. He trusts you. That's a different scenario.
Well, there's always that, these searchers, they go to Harvard, they go to Wharton, they go to Stanford, Kellogg, Rice, Booth, all the major ones. And they have a choice. Do they want to come out and be a traditional searcher? Or do they want to come out and be a self-funded searcher and own 80% of the business and take the PG and take the risk? Or do they want to be a traditional searcher, work for 15 to 20% of the business, right? Have the major people behind them, the investors, and have all that professional management. And I've had several transactions where folks have come out of the traditional search space and said, no, I'm not going to do that again. I'm now ready to own my own business. Those have worked out extremely well because they are tried and tested in battle, right? They've gone through the battlegrounds. They've owned the business for 5 years.
They're taking that step.
They've got, right. They're taking that step up. But if you have a guy that's coming out of graduate school and he's 23 or 24 or 25 years old with an MBA degree, he's got no real life experience in the business on how to use people, how to work with. You talk to a lot of the people at the top, it's lonely, right? It's lonely because who are they going to run to in that business? That's all on them. They're the ones that are making the decision, right?
Yeah.
And a lot of conversations that I have done during the day is when I am speaking with potential searchers is it's important who's in your cap table. It's important that if you need them, if you do, to my point, get tight on cash flow, can you make a capital call? Can you go to a couple of your partners and go, it's tight. Can you kick in $50,000 because I've got an order from overseas and we haven't gotten paid in 60 days? Because that's the reality of small business.
Deep pockets. Yeah.
Deep pockets. So it's important. I tell people, don't ask your friends for $50,000 and the guy says, all I have is 52, so don't call me again. Right? Like that's not the guy you want on the cap table.
Yeah. Yeah.
Right? You want to make sure you're bringing in people that have experience. You want to make sure you're bringing in people that have money because it's all those what ifs, right? I've had people who have bought like tow truck companies. Oh, the tow trucks are fine. They've got 285,000 miles on it, but they're fine. Right? Like, well, believe me, that's what they say, right? Oh, so you trying to convince me? And then 2 months later, they're calling going, the tow truck shit the bed. Oh, really? Like,
Yeah.
wow, what a surprise.
Couldn't have predicted that.
yeah, you could have predicted that, right? Can you lend me more money to go buy a new tow truck that's $125,000? No, but maybe you can go out and lease it, right? So it's de-risking the business, and you can't de-risk all of it because you just can't.
No, you can't. You
just can't. You just can't, right? It just doesn't work that way.
But it's better to have the experience to be able to manage those risks.
That's exactly right.
Yeah.
That's right. And it's thinking about them, right? And it's modeling out those risks. And that was the point really of the War Story Saturday that, I write on Saturday mornings on Twitter. It was to discuss all of those scenarios, not just can this business pay the SBA loan? If you wanted to just fool yourself and go, okay, I do have debt service for 2 years, albeit not that great. But what happens in reality? Do I have the money to grow the business? Do I have money to put away money to pay the seller? Do I have money to pay the pref? Do I have money to pay? The answer was no, right? So people will call me and I'll tell them it's just deal dynamics. And a lot of people will ask the question, well, is it due to because of the higher interest rates? No, it's due to the model. Look at the business model. Look what's needed in the business. Look how you take it from step A to step B, because your thought process always is, and you've heard this a million times, the seller's, he's absentee, he spends 5 hours a week there, he doesn't really know.
If I spend 35, but the business is going to be 30%, grow 30% in profits. Yes.
You got to love it, right? You got to love the enthusiasm. You got to love the thought process of going there. But in reality,
I have to tell you, I tell all my students, like, stop. No, you can't build any sand castles in the sky. Stop.
Yeah.
Just like pretend for the next 12 months, nothing happens. You just try to maintain the boat and keep it steered forward. Try not to hit any, storms or anything. So right now, you're just going to figure out how to run the business. Yeah.
And I'm sure you've seen a lot of people will say, yeah, I'm buying a business, but the seller is willing to stay on. And he doesn't want to do this side of the business. He's more interested in just the sales, but he's going to be there for the next 12 months so I can rely on him. And I tell him, well, 2 weeks after the loan closes, he's on his way into work and he gets hit in a car accident. He doesn't make it. Now what? How do you de-risk that? Because you were relying on him. And unfortunately, over my many, many, many years of lending, that has happened.
Well, I also want to point out, this is the 150 top podcasts I've done with people. They are the entrepreneurs by business. They have told me with their experience, they want the guy out because his culture doesn't mesh with the existing culture.
It's interesting that you bring that up because SBA's new rules where a seller can roll equity.
Yeah.
Right. And so
20%, right?
Yeah. Well, he can roll whatever. If it's over 20%, he's got to personally guarantee the loan. If it's under 20, every bank has their different ways that they look at it, whether he's going to provide a limited guarantee or not to that extent. But in speaking with searchers at the beginning, everyone was so excited about that, thinking that it would be a good thing for the seller to stay in. But a year or so later, I have not to date closed a transaction where a seller has rolled equity. Because to your point, a lot of the people say, I want to get in there and I want to do it myself. It'll be nice to have the seller around for a while to give me that guidance and that expertise, but not necessarily do I want him to stay on, right? So even though that at that time when the SBA came out and said, okay, we're going to allow this, everybody was, oh my God, this is the greatest thing since sliced bread. And here it is, there hasn't been much in way of that. And it was interesting. Several months ago, I got the opportunity to have breakfast with 3 searchers, all in different phases that I had provided financing for. And I said, I'm like a proud papa, right? I'm with my 3 students. And I asked them, now knowing this and going through with your experience, to your point, would you have wanted the seller to have stayed on? And all 3 of them agreed, said no. Now going through what we have, we're glad that we didn't make that opportunity, and we're glad that they didn't. And I will tell you the same for the seller businesses that I own. We do not have any of the sellers. None of them passed 90 days.
Yeah, I ran a poll on LinkedIn saying, hey, do you think anybody over 20% equity that has to sign it is going to sign a personal guarantee for you to buy the business? And you run it and be responsible for it. And overwhelmingly, about 500 people voted, and about 90% said, no, nobody's going to sign a personal guarantee.
Yeah. Even though they want a second bite of the apple, it's,
Yeah.
And again, it matters.
That going to the next level is more difficult.
Yeah.
Yeah.
Because you think, everybody comes in and says, oh, the business has been stagnant, for 4 to 5 years, but I'm going to come in here and I'm going to take it to here.
Yeah.
Well, why? Why was it stagnant? Was it? Does the market allow for the growth? Is the market there?
Yeah.
What does it take to get to that next level? Can you get to that next level? A lot of businesses just can't, even though you want them to, for whatever
it's tapped
reason.
out. That's the domain range thing. What's your domain there? If there's already 5 HVAC companies and 2 just popped up, you're going to be limited because your capital to spend on new business is going to have diminishing returns. Yeah.
Exactly. Yeah. So, all the factors to your point, right?
So what are the learnings from this? Because I have people coming to me and go, is this 1.25 debt service coverage ratio good? And I'm on the opposite side. I'm a kind of a Dave Ramsey guy. No debt, high credit scores. Just don't like debt anymore because I'm 60 and I was in debt for a while, got out, fixed that. But I don't like that kind of debt.
Mm-hmm.
It's too much. And people don't understand what that 1.25 is. Like, right? Cash flow has got to be 1.25 larger than debt. Just not enough for me.
Yeah. And people ask, it's a great point. It's a great question. And I always come back with, what are you comfortable with?
Yeah.
Right? Because everybody
real estate guys are always comfortable with that.
Yeah. Like everybody's risk tolerance is different. In the way that I look at it, the way that I model it is I look at it and say, I talk about the what if scenarios go bad. So for me, I want to know if the business drops 20 to 25%, can I sustain? Right? And at 1.25, to Mike's point, you're not sleeping at night. Because if it does drop and you don't have now the cash, and think about it going to your minority owners going, I know you guys want prep, but I can't pay you. And that happens more often than not, by the way. Or I want to do a rebrand and I can't. Because if you start dropping below, you just don't have the cash flow to do the things that you need to do. And inevitably, when you buy a business, you are going to have expenses that you have not accounted for. That is a fact.
Yeah.
Because I live it. I live it, I can tell you. So I'll speak to some folks and they'll go, I'm comfortable 1.5 over. So if I've got, $1 million in payments, or, I want to know that I have $1.5 million in cash flow. So I want that buffer, right? A lot of people will fool themselves. Well, maybe I can take a little bit less in salary. or maybe I can do this a little bit different. Or, you know, when we were first making loans, when I first joined First Bank of the Lake 4.5 years ago, prime was 3.25. Prime was
Crazy,
8.5
easy,
now, right?
cheap money.
Yeah.
Sign 'em up.
Right. So imagine now, right? 4.5 years later, who modeled in for an increase of from 3.25 to 8.5?
And I saw some of those loans are 12%. Like that time
Yeah,
it's crazy.
because if you do prime plus 2.75 or prime plus 2.5, you're at 11%. Who was modeling that back then?
No kidding.
You were doing prime plus 2, you were at 5.25. Now you're at 11.5. So imagine if your debt service was that tight, John. You're below. You're in trouble. That's why you see loans now that have been seasoned for 2.5 years now starting to go, wait a minute, right? Because they were based upon, then you had the PPP money, easy access to capital. But now you're starting to see some of these businesses struggle a little bit. And that's why banks are tightening a little bit. You're seeing it all. That's the realities of it.
Yeah.
So
I love the statement. Everybody knows the statement. You never know who's swimming naked until the tide goes out. But he also said, when you combine ignorance and leverage, you get some pretty interesting results. And that ignorance is not accounting for all the possibilities that will happen. That may happen. Just predict that they will happen.
Right.
Yeah.
But that's when you look at it, that's why when you're doing your modeling and you're looking at the what ifs, you can't just go, well, I'll worry about it when I have to pay the seller 2 years down the road.
That scares me.
You have to look at it and say, do I have enough to, do I have enough to save payments over those couple of years to start doing that to make it easy? Do I have enough money over the next couple of years to do the things I want to do? Do I have enough money to grow the business? Do I have enough money to, do whatever you want to do in the business? And then the seller note starts kicking in. And the thought process, like I said, is always upside. It's always theoretical.
Yeah.
And you have to believe that because that's what you're buying, right? That's as a business owner, that's what you're buying. You can do this a little bit better. We can professionalize it. We can make it better for the next person that's it's like, I always say, it's like buying a new car and making sure that you put several floor mats on. So when you sell it 4 years down the road, the floor mats look great for the next guy. Like, that's really
that's nice. Yeah, there you go. That floor mat looks new. That's because it is. So
thanks for taking care of those for me.
Yeah. So you mentioned earlier, right when we were getting on, we was talking about when you're penciling in the difference between, not really a difference, but looking at that income statement and the accrual accounting versus cash flow accounting. The accrual down at the bottom, that net profit that number is just an imaginary number. It's a theory.
Yeah. Well, it's again that kick the can type of. So
that's what I call it. I said don't depend on that. I always say don't depend on that. Yeah.
But as I always tell, and a lot of people will come and say, on an accrual basis they're doing great, and I want to make an offer, and I tell them, on an accrual basis that doesn't give you the cash you need on Friday to make payroll. Right. Yeah. And I shared the story with you of on an accrual basis, we're doing great. Meanwhile, can you send me some cash, right? Because I got to make payroll right on Friday.
That goes on the balance sheet, by the way.
Yeah.
And in the payment on the income statement.
Payment, right? And, when you look at the financial statements, and then you look at the tax returns, you got several different methods, accrual, cash, cost, percentage of completion method. All of those different methods matter, right? They matter. But to really understand the working capital needs of the business and the cash flow conversion cycle and what you need in the bank to properly operate that business to cover yourself.
Yeah. This is one of the biggest discussions I want to have is about the working capital. I'm opposed to borrowing money if the seller wants to take all the working capital out. I say, you got to leave whatever your turns are. That first turn is leave that in as working
Yep.
capital. Like if you're an internet business and you credit cards, look, less than 30 days, right? But if you're a manufacturing business where your customers pay you in 60, 90 days, you need 60, 90 days of working capital.
100% agree. But what happens is, in reality, is this is what sellers say. You mean I took product that I paid for and I sold it? It's money due me. It's from my efforts and energy, and you want me to leave it to you?
That's always the argument. Yes.
Right? That's what they say, right? And sellers don't understand that they have to leave you their money for products and services that they've supplied. They just don't understand it. And to your point, let's say you came in and you said, okay, this business is throwing off $1 million in EBITDA, on an accrual basis, and you're going to offer $4 million. So you paid $4 million. And the seller says, well, I'm not leaving you the working capital. And you do a working capital adequacy model, and it's $500,000. So you say, Bruce, I need to model in $500,000 to the balance, either whether it be a line of credit to the balance sheet. Well, now you're paying $4.5 million for the business.
Yeah.
You're not
Well,
paying
it's
$4.
actually more. If $500,000 over 10 years is almost $800,000.
Right.
So
So you're paying for that. But what the sellers don't understand is that's an asset of the business.
that's right.
And so Main Street deals, right? Smaller deals under $1.5 million is what I kind of consider Main Street deals. Working capital generally is not included in the business.
Mhm.
It's just generally not. But if you're buying a lower middle market M&A and you're doing the transaction that's $5, $6, $7 million, yes, working capital is normally
Must
included
stay.
as
Yes.
part of the deal. And here's the problem that I have, though, John, in talking with a lot of the clients. Brokers will give you a SIM, and the SIM generally, it might have one period of the balance sheet. Might. But they want you to submit an before they start giving you the tax returns, or before they start giving you
It's like,
financial due diligence.
okay, let's lay down the cards.
Right.
You lay down? Yeah.
Right. So you submit an LOI that says the normal language, right? It will be the normal working capital over the last 12 TTM. That will be the peg, blah, 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 blah. But you really don't know what that is because you don't have monthly balance sheets to know, is the business seasonal,
Yeah.
right? You don't know if there's more working capital because they've experienced this tremendous growth over the last 2 or 3 years.
Yeah.
Right? You don't know a lot about that business with just a one picture in a SIM, but yet they want an LOI. And then when you have to go back and retrade it and go, yeah, we need this amount of working capital, and the seller doesn't understand it already. And then you try to go in and do a real number and try to do a true up. I can tell you, and this is unfortunately a fact, that in 2022, I had 5 transactions. In 2023, 4 transactions, and 2 transactions this year. So that's 11, 5, 4, and 2 of transactions approved and in closing that never hit the closing table.
Yeah.
And it's all over the working capital issue.
Yeah,
I want
that
to share
is,
one story with you, if I can, just to
yeah,
put
yeah.
some credence on this. So I had a transaction. It was for a gentleman buying a business in Connecticut. They distributed a product. It was a product associated with the building industry. And they put in there, the seller shall leave $525,000 of sellable inventory. Right in the LOI. We get the deal approved. They're in closing. They're a couple of weeks from closing. They're doing the final purchase and sales agreement. And they said, okay, we're going to have next Tuesday, we're going to do an inventory count. and we're going to get the balance sheets ready for closing. And they do the inventory count, and there was like $225,000 in inventory. So the buyer says to the seller, here's the LOI. We signed, you agreed to leave $525,000 in sellable inventory. The inventory count just showed there was 225. You need to buy $300,000 worth of inventory prior to our close. And
Yeah,
the seller
so
will-
I can immediately see that they're not going to accept that request.
right, and it's
Yeah.
exactly what happened, and the
Yeah.
deal never closed. And it was a $5.4 million transaction.
What's a better solution?
I don't know if there's a better solution. It's just the disconnect.
Did you reduce the price of the acquisition by $300,000?
Not by $300,000, because the amount of inventory that it required to produce that level of sales, which then equated to a certain amount of EBITDA, of
Yeah.
which then the multiple that you were going to pay.
It's different.
So right, do you understand
yeah.
where I'm coming from?
Yeah,
So
you got to turn assets into cash flow, and that $300,000 could be worth $1 million.
Exactly, because you have to right. Like, so some people will say to me, well, if the client's got a concentration and that client goes away, how much should I reduce my price by?
Right. You got.
And I say, you have to look at the contribution margin of what that client did and then multiply that. So if that client represented $1 million in revenue, but represented 300, let's say you had a 25% profit margin, $250,000 in profit to the bottom line.
Yeah.
And you were paying a full multiple, that's going to be worth $1 million.
Yeah.
Right? Very simple. So to go through that equation of what that inventory would generate to the profit margin, to the term, and then a reduction in price, which is when they called me, I said, that's how you need to do it. The seller came back and said, hell no.
Well,
Hell no. And the deal imploded and it tanked and it didn't close. That's the point, because how in the LOI else would you, right? I mean, this was a big business. They were paying a lot of money for $5.4 million. So you can imagine, what it was throwing off in cash flow. So it was significant. It would have been a significant reduction, and the sellers weren't going to do that. And
that's a great problem that you're never going to encounter unless you're in the situation right then and there. And there's no way you don't know how to solve it unless you've done it before. Or if you had somebody do it before. Yeah.
Yeah. So, you're always trying to bridge that gap. I mean, LOIs, retrade. I recently had a transaction, right? 5 lines in. This transaction will be an F reorg. We get the loan approved. We send the commitment letter to the borrower. 4 days go by. The borrower doesn't return the commitment letter. So I know obviously there's something wrong. So I call the borrower. Hey, what's going on? Haven't received the commitment letter back. He goes, seller's having a problem with the F reorg. I said, the seller should not have a problem with the F reorg. Yeah, but he doesn't understand the implications. I go, yes, and that's why he signed it immediately, right? Like, he signed the LOI, but he didn't understand what he was signing, right? So he says, Bruce, I'm stuck. I don't know what to do. I go, well, good thing I did. And I said, here's the person you need to call, and you need to have that discussion. And what needs to happen is the seller's CPA needs to be on the call, because the seller trusts the CPA. And if the CPA understands exactly what's going on, he'll be able to convey that to the seller. And he'll be able
a champion for that party. Right.
And then 2 weeks later, they agreed and we're about to close the loan. But the seller signed it. He saw it, but he didn't understand it.
He didn't know what the implications were.
No, but to my point, John, that happens consistently.
Yeah.
Consistent. It's just knowing how to navigate that and walking through that and having those conversations, which I do beforehand, to try to hopefully put my buyer in a position where it's not going to happen to him. You just don't know.
Yeah. So, what would you call, if you were to draw an analogy or a metaphor of what this looked like you got to understand the implications. Is it chess? If I move this chess move, it's this, or is if I play cards, this is what it is. But what have you learned about sharing this information with your buyers? Like, hey, just slow down. We really got to map this out.
Yeah. And that's, I would tell you that I'm with my borrowers months before, we get a transaction, completed. So it's not, I don't work with a lot of business brokers. I don't work with a lot of, loan brokers. 95% of my clients come to me directly, and we're looking at one deal and it doesn't work. We're looking at the second deal, it doesn't work. And then finally the third deal is getting done, because it takes a number of times to get up at bat and strike out before you really understand the questions to ask the seller. Like I want to know, when's the seller taking his last vacation? Where did he go? And for how long? Why is he selling the business? There's 3 reasons the seller sells. He wants to, he has to, or he needs to. And there's difference for all 3 scenarios. And the reason matters, right? It really, really matters whether that deal is going to get to the closing table. So the conversations I have with my clients are not just, hey, you're under LOI. Very seldom do I get deals to the closing table where somebody calls me and says, hey, Bruce, I'm under LOI. Will you help me?
Yeah.
Generally, I don't.
They got to line you up before that. Yeah.
Because it's just to why we're having this conversation, John. There's so much more to get a deal to the closing table. It's not just debt, right?
Yeah.
It's just not, there's just not debt. I love that. Yeah.
Yeah.
I love it.
And there's our conversation.
I'm going to paraphrase you. Yeah.
Well, I got to come up with a YouTube thumbnail, man. It's a YouTube thumbnail. Debt.
Little trademark with a little R, right? With JR.
Yeah.
Type of thing.
I got to run it through ChatGPT first. Bruce
Awesome.
Parks, thank you so much for spending time with me.
I am thrilled to have done it. I'm thrilled that you asked me back. I always enjoy our chats and our conversation. They're always inspiring and thought-provoking, and hopefully we provide value to those that are listening.
Hopefully we do, right?
Yeah, right.
This is a business. It's like, you buy a business, it's one and done, right? You may never buy another business in your life.
That's true. Yeah, that's true.
Why would you want to get good at the skill unless you're going to do multiple and you knew you're going to multiple? Usually you don't need a lot of help, right? But if you're doing one, probably should have a little help going into that, right?
Yeah, I agree. Yeah. I agree, for sure.
Yeah.
For sure.
All right, Bruce, thank you so much.
All right. Thanks, Sean. Appreciate it.